the Mortgage Guy, Mortgage Mondays, episode 33, where I'm talking lender credit. Matt, the Mortgage Guy here, Mortgage Mondays, episode 33, where I'm talking lender credit. And I want to make this video. I've had more and more folks that I've been advising lately where taking a lender credit is really a good option. And let me explain what lender credit is first. When you are qualifying for a mortgage, you're given an interest rate which is at par, meaning you don't pay any points to get that interest rate, nor do you get any credit from the lender. So let's call your FHA loan 3.5% at par. If you wanted to buy down the interest rate to 3.375 or to 3.25, you could do so by paying points. And that rarely happens. More often the case, somebody wants to bring less money to close, so they're going to take a 3.625, a 3.75. In return for this higher interest rate and slightly higher monthly mortgage payment, they're going to get a credit from the lender. Here's a quick real-world example so you can understand it even more. $300,000 purchase. Person's going to be putting 3.5% down. So their down payment is $10,500. Now, closing costs might total about $7,500. So their cash to close is going to be $18,000 if they choose to take that 3.5% interest rate. If they would rather bring less cash to close and they don't mind a slightly higher payment, we can put that person in a 3.75% FHA loan and give them, in that scenario, about a $4,000 credit. So they would come to the closing table with $14,000. Yes, they'd have a slightly higher monthly mortgage payment, but they wouldn't come out of pocket with as much. And honestly, this, more often than not, is the best option for borrowers. If you've got the choice between $40 more per month or an extra $4,000 in your pocket, and you don't plan on staying in this loan for 3, 4, 5, 8 years, it's probably in your best interest to take the slightly higher rate and take a lender credit. So in that specific scenario, you're getting a $4,000 credit and you're paying $40 more per month. So it's a 100-month break even, which is about 8 years. If you plan on being in that loan for less than 8 years, it makes sense. So in summary, lender credit, you're taking a slightly higher interest rate, and in return, the lender is giving you a credit towards your closing costs. Now, this credit can't be applied to your down payment, but it can cover a portion of up to all of your closing costs. So if you really wanted to limit your cash to close number in that $300,000 scenario, you could take a 4% interest rate, which is going to give you just about enough credit to cover all of those closing costs, and your cash to close would be $10,500 in that scenario. Any questions, please feel free to reach out. Matt the Mortgage Guy, Mortgage Mondays. Until next week.